Well, the big story that we are breaking at this hour, the Reserve Bank has released its discussion paper for NBFCs. It has proposed a 4-layer regulatory framework structure. Further, the Reserve Bank has proposed that the entry point for NBFCs be hiked to 20 crore rupees from the current 2 crores. Lata joins us now. Lata, this was much anticipated ever since over the weekend. The RBI Governor Shaktikanta Das said that the Reserve Bank would reveal the roadmap for NBFCs. I know you've been poring over the discussion paper. What are the immediate implications, if any?
Well, first a disclosure, it's 45 pages of very difficult reading. So I'm barely able to get my head around or even my hand around these 45 pages. It is 4 layers that they have identified. But importantly, there is nothing in the top layer. Eventually, some NBFCs may become so large that they may have to be included in the top layer. So we are basically discussing only 3 layers: base layer, middle layer and upper layer. Base layer, as you said, the net owned funds condition was 2 crore. Now you have to have a minimum net owned capital, that is owner's capital, of at least 20 crore. And then the rules that apply to them have not changed significantly. One very big change is this base level guys used to originally identify as NPA when the payment had not come for 180 days. Now that is being reduced to 90 days. So they're getting the common rule which is applicable to everyone else. Remember, if your size, total asset size is less than 1,000 crore, that is out of the total 9,400 NBFCs, 9,200 NBFCs are in that category. They're really small NBFCs. So, it may not be very big in terms of a system impact. The real changes are coming for this top 200, which are middle layer and upper layer. And how will you identify them? Partly it is size, and then it is their scale, how interconnected they are and how complex they are. So now I have not read enough to understand what will be the cutoff points between middle layer and upper layer. The more interconnected you are, interconnected in the sense you have taken money from mutual funds, you have taken money from insurance companies. So if you go down, a whole host of entities get impacted. That would be a more interconnected company. A less interconnected company would be that which has its own funds and it has largely raised money, say, only from the banking system. That would be a less interconnected company. These are the kinds of categories that are being mentioned. Again, I'm not giving you a very clear idea because I have not gone through that much. But that is the distinction between middle level and upper level. There is a size difference, complexity difference, and interconnected difference. And then for the upper level, there are more conditions that are likely to be imposed. See, this is a discussion paper, so all this is up for discussion. They are likely to have more capital restrictions. They are likely to have less leverage. A bank, you lever up, an NBFC has capital of 15%, and it can take leverage of 6-7 times. Now, if you are an upper level NBFC, you are probably going to get less leverage. And then there are more disclosures. Their key management personnel cannot take positions in other NBFCs. These are basically the kind of conditions that are being imposed by the discussion, or at least being proposed by the discussion paper. Well, I've not been able to go through everything, so let me defer to an expert who probably has read a little more. Okay, Santanu Chakrabarti of Edelweiss Financial Services has just joined us. Santanu, thank you for joining. What have you been able to grasp? What may be the higher restrictions or conditions that may be imposed on larger NBFCs?
My pleasure, Lata. Thank you for having me. Let me just clarify one thing that you were mentioning as to the method of that classification. They have laid out specific criteria for making out that classification. It's a weighted score system where they have liquidity considerations, exposure considerations, interconnected. So size and leverage has 35% weight, interconnectedness has 25% weight, complexity 10%, where they are basically talking about if somebody has non-linear derivative kind of exposure.
Yeah.
Then the type of liabilities, is it deposits, in which case, of course, the abundant caution is built in is high. Then, of course, group structure and all the other FHC kind of regulations and such parameters.
1 minute, Shantanu, when you look at it, are you able to say which or how many companies are going to be in the upper and middle level? Are you, offhand, I mean, would you say Bajaj Finance or HDFC? I guess this applies to housing finance as well.
Right. So they have made a very dramatic statement out there where they mentioned two particular newly listed banks and set out their, asset sizes at 90,000 and 150,000 crores, and then made the point that one of the NBFCs is north of 500,000 crores. But other than that, my initial reading was the same as yours.
That we don't know whether there is a cutoff size.
Yeah, the upper limit is a null set.
Yeah, upper limit, no, the top layer is a null set. But upper level, there should be some, and middle level, there should be some, right?
Right. So that they are calling that the upper layer.
Yes.
And even for the upper layer, if you go and look at the kind of convergence that they are talking about, none of it is as dramatic. So what are the convergence points? Things like corporate governance, fit and proper criteria for management.
Yes.
Group exposure limits at the top level being convergent with what the banks already follow. There's no SLR CRR.
Yes.
There's no forced stoppage of growth. There's absolutely no indication anywhere in the document that the RBI has anything but a developmental goal for NBFC.
Yeah, 1 minute.
And even
1 minute. You're absolutely right that CRR, anyway, they're considering it as only a monetary tool. It is not meant to be a prudential tool at all. SLR as well hasn't been suggested. But what are the capital rules that you could make out? I thought there is something called capital regulation, 9% to be stipulated. Is there is a CET1 of 9%.
Right.
Is that the big change?
No, so Lata, what they are suggesting is that other than the usual tier 1 norms, which they are keeping unchanged, they are saying out of that 9% has to be equity-like instruments, which is basically CET1, right? So that's the only thing. And they have also said that apart from having a prudential amount of capital, such an NBFC may also be asked to comply to a certain leverage threshold. Now, as you know very well, while it was not de jure there, de facto this already applies because every NBFC has to go out and get a rating. No rating agency will, I mean, you know, some of the risk weights in housing loans, etc., can be as low as 35%.
Okay.
But no rating agency is going to give you a good rating at 36 times leverage.
Okay.
So some of these things are somewhat theoretical as of now. They're meant to set
standards,
boundary marker points of behavior rather than of immediate implication to the group.
Okay, 1 minute, Santanu. 1 minute, hold on. Maybe by then you will be able to read a little more. I have Gagan Banga, the Managing Director of Indiabulls Housing, with me. Gagan, thank you very much for joining at such short notice. Now, I don't know how much you could absorb in this short time, but what are your initial thoughts? I think it will mean higher capital, CET1 of 9% for the larger NBFCs and highest provisioning, it looks like. Standard provisioning will be 0.4 for a middle level and maybe even higher for the upper layer. What are your initial thoughts from all this?
Yeah, Lata, so thanks for having me on your show. I've barely reached page 31 so far, so I'm also still absorbing. But the three key takeaways for me are that the large NBFCs and the tiering that they're speaking about, that in some ways was informally already happening by way of various stakeholders. As my co-panelist very rightly said, that there are rating agencies, etc., which are looking at leverage beyond risk-weighted assets, etc. And my sense is that this is the various criteria I've observed in which will eventually cause the objective layering of the NBFCs. You would have 10 to 15 NBFCs which would be in the second to the highest possible category, right? So these entities, in my sense, are already operating at significantly higher CETs. To be operating at sizes of give or take 100,000 crores, you have to have much higher CETs than what is prescribed by the regulator in order to have that sort of a borrowing program.
Okay.
So I do not see whatever I've read so far to be in the least disruptive.
Okay.
As a matter of fact, what I've been saying for a long time, and I would like to repeat it again, this kind of a formalization of guidelines and this perceived arbitrage getting reduced between banks and non-banks is actually hugely progressive for non-banks.
Okay.
Non-banks should be in a position, much like a bank assumes that a certain amount of deposit would continue and then looks to fund growth via accretion of new deposits. Non-bank has to get into that position where refinance is an assumption, and that would only happen if the wider market believes that the regulation is as tight.
Okay.
So in that sense, this is extremely progressive. And the last point I would make is that over the last few days, there was fear of disruption, CRR, SLR, priority sector, and whatever else. What this seems to me is a very, very progressive discussion paper.
Okay.
It would set the base for NBFCs to become even more relevant than what they are in the system today.
I must urge you to watch CNBC TV18 a little more. We did break the news that CRR is definitely not contemplated, and even SLR not for non-deposit taking, only for deposit taking. I think it's already there, 15% or thereabouts. SLR is already there. So we did break the story that CRR, SLR is not being contemplated, but more other kinds of rules like fit and proper for directors. Hold on for a minute, Gagan. Let me ask if Santanu has been able to make more progress than the 30 pages. Actually, I started reading from the back where there is a very helpful table. So over there you have some evidence that the capital may be raised to 9%. There is something called LEF as applicable to banks. Santanu, what do you make of that? Is it leverage?
Yeah, I think it's leverage on effective funds, but I need to check. But Lata, if you just go back to the main points that you're talking about, it's all governance centric and constitution of board and levels of supervision. And that too, full convergence is aimed for the top level. They're talking about setting up a core banking system in line with what the other banks already have been mandated.
Okay.
So technology tightening, governance standard convergence, that too only for the top level. And the kind of fears that were there in the market are very clearly unfounded, Lata.
Okay. Yes, absolutely. Actually, I'll do one thing. We've got an initial idea from both of you, Gagan and Santanu, on what the rules are likely to be. And as both of you point out, there is nothing disruptive. Largely, rating agencies have been applying this, and companies, NBFCs have been applying it so that they will get funds from the market. Gagan, any final thoughts that you want to make before we wind up?
The other thing that this document emphasizes repeatedly is that the business models of NBFCs are heterogeneous. It does recognize that NBFCs do lend to sensitive sectors, but it also appreciates that institutional credit is required for sensitive sectors. So in that sense, these guidelines are in some ways not disrupting even that. So the fear that sectors which are otherwise vital to the economy, such as real estate, would get starved by for funds because of these guidelines was again another fear which was sort of unfounded.
Okay. Well, so many fears in the market like CRR, SLR and not allowing NBFCs to fund certain sensitive sectors have gone out. So probably there'll be some bit of a relief in the stock markets on Monday. But we will of course have more granular detail as we plod through those 45 pages. Gagan Banga and Santanu Chakrabarti, thank you very much for helping us understand a little more of this very important discussion paper. Shireen, just a word, it's not as disruptive or as restrictive as the market feared. As we broke the story, CRR, SLR have not been increased. It is more in terms of amount of disclosure, amount of provisioning and exposure to various sectors for larger NBFCs that is being prescribed. And even now we don't know which of the NBFCs will fall in which bucket. The sensitivity analysis will have to be done. So at the moment for the markets, it's a sigh of relief.
Yes, I would imagine so, Lata, because both Shantanu and Gagan were absolutely clear in their verdict that at least the fears that the market went in with to this discussion paper, those fears have largely been found to be unwarranted, unfounded, and what is very clear is that many of the measures that the discussion paper is focusing on are governance-centric, as Shantanu was pointing out. Lata, I will let you pour over beyond page 31 or wherever you were, and we'll come back to you with more. We'll take a break. There's a lot more coming up here on CNBC TV18. We're analyzing the RBI discussion paper for NBFCs in real time. Stay tuned to CNBC TV18. We'll be back with more.